What if the biggest mistake you're making with your money isn't spending too much? What if it's simply letting too much of your money sit still? Think about this. You've finally started doing the responsible thing. You're saving money every month. Maybe it's $100. Maybe it's $200. Maybe it's more. You watch that savings balance grow, and you feel good about it. You're being disciplined. You're building a financial cushion. You're doing what you're supposed to do. But then one day, you open your banking app, and you see $10,000 sitting there. Sounds great, right? Except there's a problem. That $10,000 might barely be growing. Your bank could be paying you a tiny amount of interest while prices around you continue to rise. And that's when you start asking yourself a very important question. Am I actually building wealth? Or am I just storing money? Because saving money and investing money are two completely different things. Saving protects your money. Investing gives your money the opportunity to grow. And understanding the difference can completely change your financial future. So if you have money sitting in savings right now, and you're wondering how to move from saving to investing without putting your financial security at risk, let's make the process simple. Step 1. Build your financial safety net. Before you start investing aggressively, make sure you have money available for emergencies. Think about the things you can't predict. A sudden job loss. A major repair. An unexpected bill. A financial emergency can happen at the worst possible time. And if you don't have cash available, you might be forced to sell your investments when the market is down. That's exactly what you want to avoid. A common starting point is an emergency fund covering roughly 3 to 6 months of essential living expenses. This money isn't supposed to make you rich. It's supposed to protect you. Think of it as your financial shock absorber. When life hits you unexpectedly, your emergency fund takes the impact instead of your investment portfolio. Once you've built that foundation, you can start thinking about your money differently. Step 2. Separate your safety money from your growth money. This is a simple idea, but it can completely change how you feel about investing. Think of your finances as 2 buckets. The first bucket is your safety bucket. This is money you may need soon. Your emergency fund. Your short-term expenses. Money that needs to remain accessible and relatively stable. The second bucket is your growth bucket. This is money you're investing for the future. Money you don't expect to need anytime soon. Because here's the important part. Your investments are going to move. Sometimes they'll go up. Sometimes they'll go down. And sometimes they'll go down a lot. That's normal. The mistake is investing money that you can't afford to leave alone. When you separate your safety money from your growth money, market volatility becomes much easier to handle. Step 3. Start small. You don't need $10,000 to become an investor. You don't even need $1,000. The most important thing when you're starting isn't the size of your first investment. It's building the habit. Maybe you start with $50 a month. Maybe it's $100. Maybe it's $300. The amount matters. But consistency matters even more. Because investing is a long game. Let's say you invest $300 every month for 25 years. If your investments averaged 8% annually, you would contribute $90,000 of your own money. But your account could grow to roughly $285,000. That means nearly $195,000 of the final amount would come from investment growth. That's compounding. Your money earns returns. Then those returns have the opportunity to earn returns of their own. And the longer you give that process to work, the more powerful it can become. This is why starting early can be so valuable. You don't necessarily need to invest huge amounts. You need to give reasonable amounts. Enough time. Step 4. Keep your investments simple. This is where beginners often get overwhelmed. They hear about individual stocks, options, day trading, cryptocurrency, technical analysis, complex trading strategies. And suddenly, investing sounds like a full-time job. But building wealth doesn't have to be complicated. One approach many long-term investors use is a diversified, low-cost index fund. Instead of trying to predict which single company will become the next big winner, you're spreading your investment across many companies. That diversification can reduce the risk of relying on one company to succeed. You're not trying to become a professional trader. You're simply giving your money exposure to a broad section of the market and allowing time to do its work. And honestly, that's one of the most important lessons in investing. Building wealth doesn't have to be exciting. Sometimes, boring is exactly what you want. Step 5. Prepare yourself for the bad years. Because eventually, the market will fall. You could open your investment account one morning and discover that your portfolio is down 10%. Maybe 20%. And when that happens, you're going to hear a little voice in your head saying, "Sell everything before it gets worse." That's the psychological part of investing. When prices are rising, everyone feels like a genius. When prices start falling, fear takes over. But if you're investing for the long term, market declines are part of the journey. You can't control when they happen. You can't predict every one. But you can control how prepared you are for them. And if you're investing consistently, a market decline can actually mean your regular contributions are buying more shares at lower prices. The goal isn't to avoid every crash. The goal is to build a financial plan that doesn't force you to panic when a crash happens. That's the difference between investing and gambling. You're not trying to win tomorrow. You're building something for years from now. So let's put the entire process together. First, build your emergency fund. Second, separate your safety money from your long-term investment money. Third, start investing an amount you can comfortably maintain. Fourth, keep your investments simple and diversified. And fifth, stay consistent and give compounding time to work. Because here's the truth. Wealth is rarely built from one incredible financial decision. It's usually built from ordinary decisions, repeated for a very long time. Saving gives you stability. Investing gives your money the opportunity to grow. And time is what allows compounding to become powerful. So if you currently have money sitting in a savings account, don't feel like you've done something wrong. Saving is where the journey begins. But eventually, you have to ask yourself, how much of my money needs to protect me? And how much of it can start working for my future? That question is the bridge between saving money and building wealth. If this video helped you understand that transition, subscribe for more practical videos about money, investing, and building long-term financial freedom. And let me know in the comments. Are you still focused mainly on saving? Or have you already started investing? I'll see you in the next video.